as a non-performing note investor, how you might see this from the many possibilities in the business. Here's my crazy looking mind map of the flow from a loan being originated, performing as agreed, just like on the PPR version, to a refinance or payoff, and then the non-performing life cycle, which starts as a 90-day late NPL. A demand letter would be sent at this point, and then it can either go to a forbearance, a loan mod or reinstatement, or to a foreclosure. The forbearance and the foreclosure are lined up here because that's the point of a forbearance, to hang out with that foreclosure as a potential resolution. Just flip it to continue the foreclosure if the borrower doesn't perform on the forbearance. And then if you do go to the foreclosure, you set your upset price. If the upset price, which is the amount your attorney is bidding at the auction, is exceeded, you get the payoff. If the bids from the competition are less than the upset, you win the bid, you get an REO. And maybe a point to mention here with the forbearance, which I thought was really useful, was that this doesn't trigger some accounting issues. When you create a loan modification, there's some phantom income in some areas. And I'm not super sophisticated on the tax side, but in this case, with a forbearance, you're keeping the original terms. You're not recasting the loan with a new loan mod. So the three options. This continues on here. Kind of spell out each step. At origination, with secured liens, we have seniors or juniors. Juniors could be seconds, thirds, fourths, anything past just being a first position loan, or they can be unsecured. And obviously unsecured loans carry a lot less value. An unsecured loan is about 100x less valuable than a secured loan. That's a price of 50 cents on the dollar versus 50 basis points, half of 1%. A little pro tip for members of the group here is that we use our pro member portal, searching any zip code, pull up the county database, and then there's links to the specific county, so you can double check that a loan is secured. And if they have public records online, you can also find the lien position using that data. And what's cool about these PDFs, the links here are interactive. So these link to stuff on YouTube and other resources. So then the performing side. Now in this business, reperforming loans are when a loan has went into default and back on track, but a performing loan, it's paying as agreed. And from origination to refinance or payoff, it just happens per the terms of the original contract that was signed. It's interesting in this space, these loans are traded on the secondary market, but they're traded in massive volume, often securitized. And the bigger the transaction, the lower the yield. These deals are often less valuable, as you'd expect, I suppose, priced less aggressively because of the fact that they're more safe. The bigger the trade, the more institutional players are interested, and the cheaper cost of capital means they can pay far less than we expect. These are going to trade in the single digits versus reperforming loans in the 10, 12, 15% cash on cash returns. And the pro tip here, if you want to make your reperforming loans more valuable, you can use a notarized loan mod, and you can securitize these loans, if you have enough of a package, into a more valuable asset. Now, this is a pretty advanced strategy, and I don't even venture to guess what the minimums would be here, but you need a pretty large portfolio of reperforming loans to securitize. If anybody has done the strategy before, securitizations be something interesting to share. We've kind of done the opposite. Some of our calls has talked about securitization wind downs, where a securitization is separated and turned back into whole loans. But in our world, it's not often going the other direction, but would be interesting to hear. On the non-performing side, the demand letter is sent and then a foreclosure or an REO. What I didn't share here, which I think would be interesting, it just seemed like another layer of complexity to that flow chart, is the charge-off process. Because that's how most of the loans hit the secondary market in our world. They're non-performing, and instead of sending the demand letter, I need to have another path that goes up, and this says charge-off right here. That would make a ton of sense, because charge-off is what a bank does instead of sending the demand letter, so that they can write it off, get the accounting relief, and then sell it to one of us in this group. And then the foreclosure and the REO. Just in general here, these are some of the steps of sending a demand letter, setting an upset price with your counsel. Actually had a deal the other day that's currently in an interim servicing period. So the seller reaches out to the buyer and says, we've got a foreclosure auction coming up. What do you want to set your upset price at? So we're instructing the seller's counsel to complete the upset price, and intentionally we reduce our upset bid as low as we'd feel comfortable with, with because we don't want the REO. The headache and logistics of managing an REO are the exact opposite of why we're in the notes business in the first place. So we like to set our upset prices pretty low. You'd say aggressively, I guess if you're talking high. We set them very conservatively. We don't want to take back REOs. And as a note investor buying loans at less than 60 cents on the dollar often, you have that wiggle room. You don't need to bid the full principal balance. You don't need to get a full payoff because you can make a profit even if you're only collecting 70 cents on the dollar. And who knows, sometimes the bid at these auctions does go up pretty significantly and we don't want those REOs. The pro tip here is to use the states database because we have a list of timelines and estimated costs for REOs and foreclosures. So really useful. And this link is FIXnotes.com/metrics. Very useful to check this out if you're interested in seeing the current deal flow, like where the market is at the moment as far as percentage of UPB and the type of asset classes like equity seconds or firsts that are secured by properties in different states. That metrics spreadsheet has a lot of detail there. For loan resolution, I think the two biggest points of your loan resolution process are to build rapport and gather intel. The rapport is just really the good faith kind of feelings that the borrower has towards you or your loan resolution specialist because of your tone of voice, because of the empathy you provide, because of the genuine concern that you have to get them back on track. And the other side of that is this line here, sitting on the same side of the table. I really like the idea that a loan resolution specialist is going to bat for the borrower. They're helping the homeowner out. The homeowner is really against the loan committee. We used to call it the investment committee, but the investment committee was a little bit too about profit. They're making money at the borrower's expense. The loan committee felt a little bit more friendly, but still the bad cop. As the resolution specialist, being the good cop, you go to the homeowner to work out a deal. You're helping them out. You're working together with them to bring their financials to the loan committee, to bring their hardship letter, to bring their loan modification proposals or loan payoff proposals to the loan committee. And then it's not you, the resolution specialist, who's the bad cop. Behind the scenes, you're both parties, but to the borrower, you're helping them. Somebody else is the bad guy saying no. And the way we gather intel, I like this super simple 3-step script. You've heard it many times. What happened? Where are you now? And what do you want to do? And generally, if you can start the conversation with those questions, having an open mind, being curious, being empathetic to the homeowner, you're going to find out how you can help them and then bringing that potential option to the loan committee to get a deal approved. So we do have like the borrower letters, the loan modification templates, working on finding that a letter about draws on HELOCs being canceled. We put those all in the Podio Blueprints portal. And we got a link here to 2 case studies in that video. One's a loan mod. The other is a payoff. That is all linked here. 3 potentials here for a reperforming loan. And there's some nuance, but I think in general, to simplify it, you can reinstate, which means the borrower makes all their missed payments. They catch up with their late fees. And they continue with the terms of the original note. Very rare unless a loan redefaults, at least for us. It actually is more common with recently defaulted loans, reinstatement risk. And I think a lot more of us are calculating that into our bids, that especially with historically low interest rates from when these loans were originated, if a borrower is able to reinstate a loan where they were originally paying 3, 4, 5% interest, then you're on the hook now to keep accepting that low interest rate loan mod payment. So reinstatement risk, I put together these slides because I'm speaking to a group of performing note buyers. And this is more talking about how to help the borrower when they're performing loan defaults. But for non-performing investors, checking the reinstatement amount when you're doing your due diligence and being comfortable with the fact that you may have to accept that reinstatement amount and then start accepting the regular monthly payments from the homeowner is some important consideration to make when you're buying your loans. Just like we talked about having different potential outcomes all kind of documented. So if the borrower goes through a full foreclosure and you take back the REO, well, how does that look? What's your internal rate of return? How long is it going to take? Versus the borrower reinstates tomorrow and starts making the regular monthly payments. Is my return good? Is my money working for me at the rate I need it to? If not, you have to bid less for a deal that has a potential reinstatement risk. But when loans in our portfolio have been modified and then redefault, a reinstatement is normally a great thing because we already wrote them out at 9% or higher interest rate. We just want to get them back on track. Now, the forbearance to the foreclosure option is a great plan to keep the borrower's foreclosure kind of in the wings, waiting, just in case you need to complete the foreclosure. It keeps the borrower honest. It keeps things quick if they do default, and opposed to a loan mod where the they're contractually current once they get the loan mod started. You got to wait another 90 days for them to be in default to file a new foreclosure. So forbearance is really useful. One, for what I say here, a temporary hardship, when you expect them to get back on track because they lost a job, they're finding a new one, or there's some specific situation going on. But it's also really useful if you're not super confident with the borrower's ability to continue making payments. I really like distillation of a note investor's business into just three parties: the note investor, your attorney, and your loan servicer. I think at the end of the day, you need some other vendors and stuff for due diligence. You may need a door knocker, you may need a realtor to value the property or whatever. There's other parties, but at the end of the day, I think the core of a note investing business is the note investor, your attorney, and the loan servicer. The loan servicer fulfilling the licensing as the licensed servicer on the account. They do the administration, the accounting. Your attorney makes sure the letters you're sending are decent, so makes sure the loan mods look good, and files a foreclosure, the demand letter, and goes the distance if you have to. And then as a note investor, you're calling the shots. So the YouTube video here is linked about loan servicing and just my opinion on using client managed loan servicing to kind of have a balance between being the decision maker and doing what you can to speed through your resolution, and also having the servicer in the back helping with the administration. Because that's, I think, the biggest challenge. There's two sides of the spectrum. Some people want to save 25 bucks a month and just self-service their accounts. But I think it pays for itself to have a loan servicer because of just the year-end filings, the monthly statements. Like, they do so much administratively that they're set up to do. And on the other side of the spectrum is like, outsource everything. You're leaving it to your loan servicer to do the collections. And I think that that has its own challenges because loan servicers aren't really built for collections. They're built for the administration. So right in the middle is client managed servicing, where you do what you're best at, which is the outreach, the negotiations, and the servicer does what they're best with. And then the attorney can help you in the middle.